Thank you for joining us for our Taxes 101 Tax Basics webinar. We are very excited that all of you have joined us. This is an annual event that we all look forward to every cold January. So we are glad that we're able to provide this education both in person throughout the state, but then also via webinar. Because as some of you know, weather sometimes becomes a barrier to attending some in-person events, so we're happy that we're able to do this via webinar as well. Before I pass it over to our presenters, just a few reminders that to turn your cameras off and to mute yourself so that we can minimize the background noise. That would be great. If you have questions or comments, please put them in the chat box that's located at the bottom right-hand corner of your screen. We will be monitoring that throughout. And if you can make sure when you send the chat that it says send to everyone so that we all can see your questions. But we'll keep an eye on the chat to make sure that all the questions get answered. If for some reason we don't answer your question, we will be looking at it after the webinar and be sending out some information as needed based on some of the questions if we're not able to get to them in the webinar today. So I am going to hand it over to, yes, I see some people have their cameras on, so if they could turn your camera off, that would be great, just so that the background noise is not there. Okay, I'm going to hand it over to Taylor Putz from Prepare and Prosper. We're going to do a little passing of the torch today.
Hi everyone, thank you so much for joining. We've had over 80 people sign up for today's webinar. And Taxes 101 is really a partnership between the University of Minnesota Extension, Minnesota Community Action Partnership, Prepare and Prosper, the organization that I'm from, and Mid-Minnesota Legal Aid. So this is the first. So Taxes 101 really is a statewide training of both webinars. This is the first of 3 webinars happening every Thursday at noon. So next Thursday at this time, there is a webinar entitled Leveraging Tax Time and Community Resources. And then we also have some in-person trainings that have already happened throughout the state. About 5 in-person trainings have happened this week in Minneapolis, Rochester, Mankato, Duluth, St. Cloud. And the purpose of Taxes 101 is really to give you some basic information about taxes, some 2017 changes, information about locating free tax preparation sites so you can refer the people that you're serving at your organization to free tax preparation and feel comfortable answering some basic questions about taxes. So to really set the stage, no matter who you are, taxes can be super complicated. So really use the information that we're presenting to you today as a starting point when talking to people. If you encounter some complicated questions throughout the tax season or really any time throughout the year, at the end of this webinar will be my contact information and Sarah's contact information. Feel free to reach out to us. And remember that you're an educator, not a tax preparer. Really, it's the tax preparer's job to be the one preparing the taxes and answering those difficult questions. So it's okay to share information and resources, but try to stay away from giving tax advice unless you are an IRS certified volunteer. So, and lastly, you have an important role to play. You can help others make the most of tax time by encouraging them to file taxes, directing them to a free tax preparation site, and giving them some resources that can help them get their maximum refund. So really want to set the stage and talk about why tax time is a really important time of the year, especially for low and moderate income households. So about 84% of households nationally earning $50,000 or less receive a tax refund each year. And a tax refund can be used to make important purchases, pay down debt, build a savings account, and other things. And tax refunds are sometimes large for low and moderate income individuals and families. And a tax refund can be the largest check a family receives all year, and sometimes it can account for 30% or more of a household's entire annual income. Part of the reason why tax refunds are so large for low and moderate income workers is because of the earned income tax credit, which we'll be talking a little bit more in depth in a little bit. but about 334,000 Minnesotans received the Earned Income Tax Credit during tax year 2015, so when they filed their taxes in tax season 2016, and the average EITC credit was around $2,200. The last stat I want to throw out there is the cost to file a simple 1040 form in 2014 was about $152. This is just the basic fee. I've heard stories of people spending all the way up to $700 to $1,000 for tax preparation fees when they could have went to a free tax preparation site, filed their taxes with an IRS certified volunteer, received all of their refund, and not had to pay a penny on any tax preparations. So those are just some reasons why tax time is important, and really to set the stage for the technical information about tax credits that Sarah will be talking about. So I'm going to pass the mouse over to Sarah.
Hello, everyone. All right, so I'm going to talk a little bit about tax basics so that you have an understanding of things that you might want to talk to your own clients about, just to kind of keep an ear out so that you're able to kind of give them an idea of what kinds of things they might be able to claim on their tax return. Like Taylor said, we don't expect anyone to be a tax preparer based on this, but just having the general knowledge can kind of help you start the conversation with your clients about tax returns and filing tax returns, and giving them an idea of some of the credits that they might be eligible for, especially if they're not terribly interested in filing a tax return. So the important dates for 2017, by the end of January, taxpayers should have their W-2s from their employers, end of January, early February. The tax returns are due April 18th this year due to weekends and holidays, so tax day is April 18th. The 2015 Minnesota property tax refund is due August 15th. And if you request an extension to file your tax return will be due October 16th. Just kind of a side note on that, if you request an extension to file your tax return, it is only an extension to file. It's not an extension to pay. So if you think you're going to owe taxes, you either want to get it done by April 18th, or you want to send in money with your extension to prevent getting a penalty later on. A lot of times people wonder if they're legally required to file a tax return. We, in general, recommend everybody file, especially if you're under these filing guidelines. You're almost always going to end up with a refund if you've had any tax withheld. So we really encourage everyone to file, even if they are under these guidelines. But here is a chart that shows you at what income threshold you are legally required to file a tax return. So the question is, who should file? Our general answer is everybody should file. There's credits and things that taxpayers will want to take advantage of. So we just recommend everyone file. But, the people that we really want to make sure are filing are anyone that had tax withheld from their pay. So if they're an employee and, the employer is withholding tax, the only way to get that back if somebody has paid in too much is to file a tax return and ask for it. Otherwise, the government just keeps it and you don't even get any credit for them keeping it. We encourage anyone who might qualify for the Earned Income Tax Credit to file a tax return, and that can be people with children and people without children. We want to make sure that everybody's aware that, there are lots of people that can qualify for the Earned Income Tax Credit. The income limits actually go up fairly high, especially if you have children. People that might qualify for the Additional Child Tax Credit, anyone who claimed the Premium Tax Credit or bought insurance through MNsure will need to file a tax return so that they can make sure that they got the appropriate premium tax credit. If you qualify for the American Opportunity Credit, you're going to want to file. That's a credit that has to do with education. We'll go through these credits in a bit more detail as the presentation goes on, but this is just kind of an overview of the different credits that people could qualify for, so we really want to be talking to taxpayers about this. And filing a property tax refund in Minnesota. So if you're a renter or a homeowner, you really want to be aware of this. You don't even necessarily have to have taxable income to file for a property tax refund or a renter's rebate. So this affects everyone. Even people who traditionally would have nothing to put on an income tax return should be thinking about and filing, if appropriate, a property tax refund or a renter's refund. So the chart that I gave you before that shows the income levels at which people have to file is slightly different for self-employed taxpayers. A self-employed taxpayer does not have an employer paying wages and withholding income taxes and Medicare and Social Security tax. So if somebody is self-employed, you have a taxpayer who's self-employed, they need to file if their net earnings are greater than $400 a year. So that's the total amount they make minus all of their expenses. If that ends up to be more than $400, they need to file a tax return. So really what it comes down to is virtually all people who are self-employed who have any sort of net earnings will need to file a tax return. Taxpayers claimed as dependents on another taxpayer's return may still need to file their own return if they have earnings. You know, that kind of gets into the rules for when a dependent has to file a tax return. It can be extremely complicated to figure out the best way for a family to file. This typically comes up if you have, you know, a lot of times it's families with teenage children. The teenage children have jobs, but the parents are still claiming them as dependents. The teenage children will need to file tax returns claiming their own income. This is where we really recommend that, if at all possible, the whole family go to a tax preparer together to get some advice on how to best get everybody filed properly. All right. So a lot of taxpayers have taxable and non-taxable income. Not all of the income that people have has to be reported on an income tax return. The primary forms of taxable income are wages, non-employee compensation, which, you know, is oftentimes self-employment, independent contractor income, unemployment compensation, retirement plan distributions and cancellation of debt, and cash income. A lot of people are under the mistaken impression that cash income is not taxable. It is taxable. So even if you're working and only getting cash, it is harder for the government to trace that cash income, but it is legally taxable nonetheless, and people who are getting cash income should be tracking their income and their expenses associated with the jobs that they're earning from. It's, you know, oftentimes not even in a taxpayer's best interest to keep the cash income off, because all of these things are going into calculating your Social Security when you retire. That cash income counts as credit work and goes into calculating how much Social Security you'll get at the end of the day. So it's a good idea to report all of your income, and it's legally required. There is non-taxable income. This is income that does not need to go on a 1040 tax return or a state tax return. Public benefits, most Social Security, gifts, and inheritance are sort of the main things that do not need to go on a tax return. Sort of the caveat to that is, you know, as we talked about, the renter's refund and the property tax refund will take into account some non-taxable income, usually public benefits, Social Security. That return will require information about those sources of non-taxable income. One of the things that our taxpayers run into a lot is this non-employee compensation or self-employment income. Some taxpayers are not paid as employees, which means that the person paying them is not withholding any taxes, and that means no income tax is withheld and none of the employment-related taxes are withheld. So at the end of the year, when that taxpayer files a tax return, they'll have to file as self-employed. When a self-employed person files, they're responsible for paying their portion and the employer's portion of the employment taxes. So that's the Social Security tax, you know, the Medicare, Medicaid tax, and it's about 15%. So they will have to pay 15% of whatever their self-employment income is, as well as the income tax, which, you know, for a lot of our taxpayers is around 10%, 10 to 15% for income tax. This causes taxpayers a lot of problems at the end of the year because they're not aware of this. Somebody could be making an extremely, you know, modest income of let's say $10,000 of non-employee compensation, and they're off the top already going to have to pay $1,500 in self-employment tax. So it can come as a big shock, and it can be very problematic for taxpayers. So, talking, if you know a taxpayer is working sort of on a per-job basis, roofers, it's kind of all sorts of people who get these independent contractor jobs. If you know anyone who's doing that sort of job, it's good to kind of give them a heads up that they will owe some self-employment tax at the end of the year, and they should be thinking about it throughout the year. Unemployment compensation is taxable. Taxes are not typically withheld from unemployment unless the taxpayer specifically asks that the taxes be withheld. It can cause a problem for taxpayers, especially if the taxpayer was employed for the majority of the year and then starts to receive the unemployment compensation, because they're still going to be in a bit of a higher tax bracket due to, being employed for most of the year. And then when they get the unemployment and no taxes withheld, bumps up their income that they're paying tax on, but they haven't had more tax withheld. So it can cause, a tax debt to be owed at the end of the year. So we've talked a little bit about income, and now we're going to talk about, what I think we all think are the better parts of the tax return, the credits and deductions. A tax deduction reduces the amount of income a taxpayer will pay tax on. So if I have a $10,000 income and I have a deduction of $2,000, it means I pay tax on $8,000. If a tax credit reduces dollar for dollar the amount of tax the taxpayer owes. So when you do a tax return, you get to a line and it says, tax owed. A credit will actually reduce the amount on the line up to the amount of the credit. So if I get to that line and it says the tax I owe is $1,000, but let's say I have a $1,000 child tax credit, it means I can reduce the tax I owe $1,000 by $1,000, and then I don't owe any tax. So for our clients, credits are more valuable than deductions for the most part. Credits can be refundable or non-refundable, and we'll talk a little bit more about what that means in a future slide. So as you're talking to taxpayers and as you kind of learn, or you might even learn that you are entitled to some credits in previous years that you forgot to claim, this is pretty common. You can go back and amend a tax return for the 3 previous years and get a larger refund. So if you figure out, I could have qualified for the American Opportunity Credit, 2 years ago, and I totally forgot to claim it. You can go back, you can amend your tax return, and if that tax return then shows that you should have gotten a larger refund, the IRS will send you the amount of refund that you were entitled to. So you have 3 years to do this. So that means if you file before April 18, 2017, you can file for tax years all the way back to tax year 2013. So we're talking about refunds. We're talking about getting refunds. Everybody loves getting their tax refunds. People have plans for them, long before they arrive. Some taxpayers end up disappointed after tax day because of, multiple things, but one of the biggest things is revenue recapture. The Minnesota Department of Revenue has a system called Revenue Recapture that allows it to intercept a taxpayer's tax return or tax refund to pay debts that taxpayer owes to certain agencies and hospitals. The taxpayer oftentimes didn't even really realize that they owed the debt to the agency or the hospital, so it's often surprising. The Department of Revenue will send a letter when a tax return is or a tax refund is going to be captured and after it's captured. Part of the problem is our taxpayers move so much that oftentimes they didn't get the letters telling them about the debt. They don't get the letters telling them where the refund has gone. If a taxpayer does not get an expected refund from the Minnesota Department of Revenue, they can call, and the Minnesota Department of Revenue can tell them where that refund went. And then the taxpayer will need to make the decision or, check into whether the debt is really an enforceable debt. And again, that's, something that an attorney would probably be best to help with. When a taxpayer files a tax return, they need to put an identifying number on the tax return. For our taxpayers, that's either going to be a Social Security number or an individual tax identification number, an ITIN. Everyone who earns money or lives in the United States is subject to the tax laws and has to file the necessary tax returns. Even taxpayers who don't have a Social Security number and are not legally entitled to work in the U.S., if they are working in the U.S. and earning money, the law says they still need to file. Those are the taxpayers that will typically be using an ITIN to file. We really want to make sure that this information is told to everyone. It can come up if somebody gets the opportunity to become a citizen or to get some sort of, legal status. One of the things that immigration is going to look at is, if you've been here a long time, have you been complying with U.S. law? One of the biggest pieces of complying with U.S. law for, a lot of the people here is filing a tax return. And it's not always fully understood that even if you don't have a Social Security number, and even if you're working under a Social Security number that might not be assigned to you, you still need to file a tax return, and there is a way to do it. There are organizations that help people file for ITIN. Taylor, I think we'll talk a little bit about that, or it'll be in a future webinar. So there are ways to get people compliant with tax law. And so, again, especially important if somebody's going to get the chance to have some sort of legal status, showing that they've been compliant with the tax laws really helps move that along. Okay, so there's a question about the PATH Act, and this actually is pretty important, and I didn't put it in there. So the PATH Act is protecting Americans against tax hikes, and it came through in 2015. One of the things the PATH Act does for claiming credits, going back 3 years, is it used to be that if you did not have a Social Security number, your kids did not have a Social Security number, but then they got a Social Security number legally through some sort of status change, you could go back and amend the previous 3 tax returns to take the credits that you couldn't take with an ITIN. The PATH Act actually changes that. It's no longer the case. So you can't retroactively use a new Social Security number to claim credits that you couldn't claim with your ITIN. So that's sort of the biggest effect of previously filed returns and the PATH Act. There's some other things about the PATH Act that we'll get into going forward, but that is a very good question. That is a change. So if you have somebody with a new social, they can't go back. There's another question about at what age do parents not claim older children? So it really depends on a lot of things. The credits all have various ages, so we'll kind of get into it a little bit, but the earned income credit, you can claim a child up to age 19 or age 24 if they're a full-time student. For the child tax credit, you can claim a child up to age 16. So if they're still 16 at the end of the year, you can claim them. As a dependent, it's a bit different. It depends on age. It depends on how much money the child is making. So that one's more complicated. In general, the dependency is the same. Age 18, full-time student. If you claim them after age 24 or full-time student, it depends on how much money they're making. All right. Something that's new this year is taxpayers are going to be able to register to vote when they file their tax return. We want to tell taxpayers about this, and we want to encourage everyone to do it. It makes voting even easier. Minnesota is a pretty easy state to vote in, but this makes it even better. All right, we're going to talk about the tax credits. This is kind of the best part. This is where all the money comes from. All right, so I told you a little bit, we have refundable tax credits and non-refundable tax credits. We really like the refundable tax credits because a lot of our taxpayers get to that tax line, I owe blank amount of tax, and oftentimes for our taxpayers it's zero anyways. So a refundable tax credit actually turns into a payment. If you have a bigger credit than tax you owe, it actually turns the rest of it into a payment that you will get back. So if I owe $50 in tax, that line says you owe $50, and I have a $200 tax credit, that's refundable. It means $50 of that credit will make my tax liability zero, and the IRS or the Treasury will send me a check for $150. So refundable tax credits are great. It means none of the credit is lost. You get the whole thing no matter what. You either get it to reduce your tax or they send you a check for the remainder. A non-refundable credit is still helpful, but you don't get the remainder. So if I owe $50 in tax, I have a $200 credit. $50 of that credit will reduce my tax to zero, and then the rest just sort of goes away. I get no benefit from it. So we really like the refundable credit. And just a side note, you can follow along in the claimant guide while I'm talking about these. We tried to make the slides go in the same order as the guide, and the guide will give you even more, detailed information about the credits and some rules for claiming the credit. The first one we're going to talk about is sort of the biggest credit, a lot of the reason why we do this, because we think it's really important that all of the taxpayers who are eligible for this credit are claiming it. It brings a lot of money into a family, and it's a huge anti-poverty program that the government is running, and we want people to take advantage of it. So it's the Earned Income Tax Credit. This is a refundable credit, so it's one of those where you get the extra back, you get extra money from this credit. It's for taxpayers who worked in 2016 who had earned income, so either self-employment or wages. And so earned income, things like rental income is not earned income. Lottery winnings are not earned income. So you have to, have some sort of job or self-employment that's creating income. You have to meet the eligibility rules, and that has to do with, especially there are a lot of rules if you're claiming children. There are less rules if you're only claiming yourself. The credit is smaller if you're just claiming yourself. The maximum credit this year is a little over $6,200, and that's for a household with 3 or more qualifying children. Again, you have to have had earned income, wages, or self-employment. You have to have a Social Security number if you're filing with a spouse. The spouse has to have a Social Security number. If you're claiming qualifying children, the children need to have Social Security numbers. The children need to be related to you in a certain way to claim them. Typically, it's son, daughter, grandchild, niece, nephew are the general children that can be claimed. I'll just bring up one that cannot be claimed as a qualifying child. Cousins. Cousins cannot be claimed, or children of cousins cannot be claimed. That comes up a lot. So if you are claiming and you don't have qualifying children, so you're just claiming for yourself or with your spouse as a couple, you have to be between the ages of 25 and 65. You need to have been a United States citizen or resident alien for the entire year. This can trip people up too. You need to have been in the U.S. the entire year. And you can't be anybody else's qualifying child. So if somebody else could claim you as a qualifying child, you can't claim the Earned Income Tax Credit, even if that person doesn't claim you. Here is the eligibility table. So this is, what we want to keep in mind when we're talking to taxpayers. If you look at this, it tells you the maximum income for someone who would qualify for the Earned Income Tax Credit. So, when you have 3 or more kids and you're married filing jointly, that income goes all the way up to $53,000. So we really want to be talking to everyone about this. So we talked a little bit about the PASS Act, and this is the sort of second change that really affects our taxpayers. It is going to take longer for taxpayers who are claiming the Earned Income Tax Credit or the Additional Child Tax Credit to get their refunds. Their entire refund, not just the part that's attributable to the Earned Income Tax Credit and the Child Tax Credit. The whole refund will take longer to get. The IRS is going to start processing the credits on February 15th. It could take, at least a couple of weeks after that for the taxpayers to actually see the refunds in their bank account. There's no way to change this. Nobody can get it faster. The IRS is not processing them until February 15th. if a preparer says, oh, I can get you your refund faster, come to me, it's not true. Something else is going on. You are not getting your refund from the government before then. So it's really important that we tell taxpayers that. We tell taxpayers to be careful and be patient and to make plans for the fact that, this year, even if they file early, which we still, file early, get it done, but they're going to have to wait a bit longer for their refund. So we just want to prepare taxpayers for that. And if you get panicked taxpayers, asking you about it, you can explain that this is the rule going forward. The next credit we're going to talk about is the working family credit, which is it's the same as the earned income tax credit, only it's administered by the Department of Revenue and the state. So the rules are the same for the Minnesota Working Family Credit as they are for the Earned Income Tax Credit. The maximum credit for the state tops out at 2 or more children, unlike the IRS, which is 3 or more. But if you're eligible for 1, you're eligible for child tax credit. So this is a credit for families that can claim a related child who's age 16 or younger at the end of the year. The maximum credit is $1,000 for each dependent child. This is, we'll maybe talk about it on the next screen, I'm not quite sure. So you have to have federal income greater than 0. You can claim a child 16 or younger. That child needs to have a Social Security number. The person claiming either needs a Social Security number or an ITIN. So this is a credit that can be claimed even for people who don't have Social Security numbers. A parent with an ITIN can claim this credit for their dependent child. The thing that I was going to add on, I'm just going to go back to the screen briefly. So we have the child tax credit. Some of it there's both a refundable and non-refundable child tax credit. If your income is below a certain level and you're not able to take advantage of the child tax credit, there's something called the additional child tax credit. And that's one of those credits that creates a larger refund. So the family, let's say, has 3 kids. They have $3,000 in child tax credit, but they don't owe any tax. Some of that is going to come back to them in a larger refund due to the additional child tax credit. So it's really a way to make the child tax credit a benefit for lower income families. Child and dependent care credit. And this is a credit that you can take on your federal refund. The maximum credit is $1,050 for 1 dependent and $2,100 for 2 or more. There's a state version of the same credit. It's sort of like the earned income tax credit. The eligibility rules are the same, so people should be thinking about both credits. And it's for taxpayers who pay for care for a child or an adult who's unable to care for themselves while they work or look for work. There are some, rules. The person has to be your dependent. They have to have lived with you for more than half the year. But this is a really great credit for a lot of families. And it's something to, be aware of and be talking again to taxpayers about in terms of what they should be bringing to have their taxes prepared. And if they're paying for care, they should bring information about that. An opportunity credit. This credit is for families who are paying for post-secondary education for either themselves, their spouse, or their dependent. The maximum credit is $2,500. Some of it is refundable. So this is another credit where even if you don't owe tax, you can take advantage of this credit and it will benefit you in a larger refund. In terms of eligibility, the taxpayer, spouse, or dependent needs to be pursuing a degree or a recognized educational credential. They need to be at least half-time for 1 academic period in 2016. They can't have completed the first 4 years of post-secondary education, so this is for families who have themselves or their children in the first 4 years of post-secondary education. The person for whom the credit is being claimed cannot have been convicted of a drug offense, a felony drug offense. They can't have claimed the American Opportunity Credit or the Hope Credit more than 4 times. And they need to have a Social Security number or an ITIN. Lifetime Learning Credit. It's also an education credit, but the rules are much, more broad here. It's intended to sort of capture everybody who is taking advantage of some sort of post-high school education, and that's not public high school. The maximum credit is $2,000 per return. The person for whom the credit is being claimed needs to be attending an eligible educational institution to acquire or improve job skills. The student does not need to be pursuing a degree program or other educational credential, and there is no, time requirement. They don't need to be a half-time student. You could be taking 1 credit. You could be taking 17 credits. This is an opportunity for everyone, but it is all non-refundable. So this is not one of the ones that you can take advantage of if you don't owe any tax in the first place. But it has the K-12 education credit and subtraction. This is for families with children in K through 12. It is a refundable credit, and it's for school supplies. Kind of looking at the list, general things that you would expect. Some of the things that you might not expect on that list are after-school educational programs, tutoring, and academic summer camps. Families who are taking advantage of these kinds of opportunities but are paying some sort of tuition or expense associated with them should be saving the receipts because they may be able to get some of that money back in this education credit. There's also a subtraction that doesn't have income limits. That is for everybody. It's the same idea as a deduction. It lowers your taxable state income. This is a Minnesota state credit claimed on your state tax return. You have to have a qualifying child in K through 12 for the credit. So here's for the credit. The household income needs to be below $37,500 for families with 1 to 2 children. The maximum income increases by $2,000 with each child beyond 2. So if you have 3 kids, it'd be $39,500. Again, for the subtraction, that's something everyone can take. There's no maximum income, but it is a subtraction from your income, not a credit. Retirement savings credit, this is on the IRS tax return. This is a credit for people who are saving for retirement. The credit is different percentages of what you've saved up to a maximum based on what your income is. You have to be 18 or older. You cannot be a full-time student. And you can't be claimed as a dependent on another person's return. We talked about this one. This one's really important, and we want to make sure, especially, all of our Minnesota taxpayers are taking advantage of this. This is the homestead credit. So this is for property tax paid, and there's also a credit for renters, people who are renting. It is filed on a separate return. So just because somebody's filed their state income tax return does not mean that they've claimed the property tax refund or the renter's refund. So you want to make sure that you're warning taxpayers and your clients that they need to be filing a whole nother return to be claiming this credit. The maximum property tax refund for homeowners is $2,660 this year. You can't be a dependent of somebody else. You have to have been a full or part-time resident of Minnesota. You have to have paid all of your property taxes or have a current payment arrangement. So that's kind of key, making sure that everybody's up to date on their property taxes is a little benefit for making that happen. You could probably use some of this refund to pay your next round of property taxes. It's a good deal for everyone. You have to have a household income of less than $108,660. You have to have a homestead classification approved for your home, so making sure taxpayers have gone through the process of homesteading their home. You have to have owned or lived in your house January 2nd, 2017. Then we move into sort of the flip side or the, renter's side of this credit. It's called the renter's property refund. This is for renters, and it's going to be based on how much rent they're paying and what their income is. The maximum credit is $2,060. Again, you can't be a dependent. You need to have lived in a rental unit in 2016, which was assessed property taxes. In general, if you're just, in a typical rental unit, most of them were assessed property taxes. It's if you're living in some sort of charity-owned housing, that might be a little bit different. You have to have been a full or part-year resident of Minnesota in 2016, and you have to have a household income of less than $58,880. Good, last one, I think. So this is for people who purchase their health insurance through MNsure. It's not, I don't come across this a lot with my clients because most of my clients are either eligible for, a state program or they have insurance through their employer. But you may have clients that have purchased health insurance through MNsure. And oftentimes they have paid for that insurance in part with their premium tax credit. A taxpayer who has done this needs to file a tax return. They have to reconcile the credit amount they had with what they should have gotten. That can only be done on a tax return. We want to make sure that everybody's filing because they will have trouble going forward if they have not filed. And I think one of the problems is you can't get the premium tax credit again if you haven't filed and reconciled your tax credit from the previous year. So most taxpayers will know if they were eligible for the premium tax credit because, this kind of went into the process of applying for insurance through MNsure. But in general, individuals and families with income between 100% of the poverty guideline and 400% of the poverty guideline might be qualified to get a premium tax credit. They need to have purchased health insurance through MNsure. Again, this is not for people who have health insurance through their employers. They are not eligible for the premium tax credit. And they need to be a citizen or lawfully present in the United States. Individuals eligible for Medicare, medical assistance, or Minnesota Care are not eligible for the premium tax credit. Also, if you have insurance through your employer, not eligible. All right, over to Taylor, who's going to talk about free tax preparation.
Before I jump into free tax preparation, we only have about 13 minutes left. So if you have any questions for Sarah or myself, why don't you start entering those into the chat box so as I'm talking, Sarah can start reading those and then preparing answers. Free tax preparation. We say the best way to claim all of the credits that Sarah just talked about is by filing your taxes at a free tax preparation site in Minnesota. So what is free tax preparation? Taxes are prepared at free tax preparation sites by IRS certified volunteers who are passionate and will help taxpayers get their maximum refund. So all of the volunteers at free tax prep sites have to be IRS certified, so they go through a class and have to pass a test in order to prepare taxes. Free tax preparation, interestingly enough, is the only type of tax preparation where the preparers have to be IRS certified. Therefore, free tax preparation has the highest accuracy rate in the United States at 94%. There is almost one free tax preparation site in every county in Minnesota. There are over 250 of them. Free really means free at free tax preparation sites. There's no hidden fees. Sometimes people say, well, does free really mean high quality? It does. And it is actually free. So e-file is available, and when used with direct deposit, taxpayers can get their refunds quickly. And every return is reviewed by a second set of eyes to make sure there aren't any mistakes. So there are different types of free tax preparation sites in Minnesota. Some of them are VITA sites, which stand for Volunteer Income Tax Assistance. And the taxpayers that use a VITA site have to have a certain income. Generally speaking, individuals who make $35,000 or less are eligible to file at a VITA site, and households making less than $55,000 are eligible to file their taxes at a VITA site. Whereas at an AARP tax aid site, there is no age requirement and no income requirement. And then if taxpayers experience some complicated situations after they're done filing, Minnesota Legal Aid, the organization that Sarah is from, and the University of Minnesota Law Clinic has law clinics to help folks work through complicated situations. So how would you go about locating a free tax preparation site? You can do it online or via phone. If you go online to www.uclaimit.org and click on free tax preparation, you'll be driven to a site where you can find a free tax preparation site, or you can go online through My Free Taxes to file your taxes online for free. Otherwise, United Way 211 is a great resource for taxpayers. Call 1-800-543-7709 anywhere in the state. You'll talk to someone 24/7, give them your address, and they will help you find the closest free tax preparation site. This is what I mentioned in the last slide. My Free Taxes is available to anyone who made $64,000 in 2016. You can go online, file your federal, your state, and your property taxes for free. It is an H&R Block software, but we encourage everyone to start on it's a United Way page, My Free Taxes. Click File for Free. It'll bring you to an H&R Block software where you can then choose to file your taxes in English or Spanish. And the great thing about My Free Taxes is that there are folks available on the phone who can help you if you get to a spot in the process where you have a question. You can give them a call and they can help you finish your return. So we know that not everyone is going to be able to choose free tax preparation, and they might pay some money to use a paid tax preparer. And there's just a couple of tips that we want to make sure that you know about so you can tell the people that you're serving. One is checking for qualifications. Making sure that the taxpayer has, attended a continuing education class recently, to make sure they're up to speed on all of the changes that are happening for the 2017 tax season. Go online and read reviews of the preparer. Make sure that everyone else who has used the preparer has had some good experiences with them. Ask about service fees up front. Sometimes taxpayers go through the entire process and then they learn that it's going to be a couple $100, and quite frankly, that's really expensive for a lot of our taxpayers. And so I've heard stories of people ending up leaving an H&R Block because they have paid way too much. And then they go to a free tax preparation site. So ask about fees up front. Check that the preparer is accessible after the tax season. So if someone gets a letter from the IRS and you have a question, you want to call your preparer, make sure that you can reach them in June, for example. And then make sure you read the entire return before signing. Lastly, I want to mention and give a brief sort of legislative update. So this year at the Capitol, there's going to be some organizations working on the Tax Time Savings Grant Program. It's the Tax Time Savings Bill. And basically what it does is it increases funding for free tax preparation services throughout the state, so we can serve more low and moderate income individuals and families. And the bill does the second thing. It creates a new source of funding to make financial capability services available at VITA and AARP sites. So this would allow organizations at their tax sites to offer financial services such as opening savings account, pulling credit reports, and some organizations in Minnesota, like Prepare and Prosper, already offer these services, but it would allow more organizations to do so. And the last sort of update is expanding the working family credit. So if you remember from several slides ago, the working family credit is Minnesota's version of the earned income tax credit. And basically, there's a bill that would expand the size of the working family credit, so more people would be eligible for this tax credit, and individuals currently receiving a smaller credit would get more credit. We're going to answer some questions now, but we want to thank you so much for joining us. On the last slide is our contact information, but we wanted to make sure that we mentioned that there is going to be an evaluation sent to you in the next couple of days from the University of Minnesota Extension. We want to hear your feedback, especially as we're planning for next year. So I think there's been a bunch of questions, and we'll stay on probably after 1 o'clock to answer all of these questions.
I'm going to start answering questions, so stay on if you want. The main part of the presentation is done. The first question that came in had to do with how can somebody determine if their home is considered homesteaded. Typically, when you get your property tax assessment from your county, it should tell you whether or not your property is considered homesteaded. If you don't have that paperwork, or for some reason it doesn't say on your county bill, you can call the county assessor's office. That would be the best person to be able to tell you whether or not your property is homesteaded. The next question is, if you paid interest on your student loans, do you have to claim it every year? So you don't have to claim the deduction for student loan interest ever, but you would probably want to. So you should get some sort of information from your loan servicer showing how much interest you paid. If you're below a certain income level, you can deduct that interest on your tax return. So you don't have to, but you would want to. And, if the question is, can I group it all together and, take all of the interest that I paid over 5 years and deduct it on 1 year, you can't. You have to deduct, just the interest you paid in the taxable year. The next one is a question that we have. If families fail to file taxes, how far back can they go? So you can file taxes as far back as you like. You could file a tax return from 10 years ago if you wanted to, if you didn't. But you can only get a refund from the tax return for the previous 3 years. So that means if you file before the tax season is over this year, you can file a tax return all the way back to 2013 to get a refund. Again, you can file other returns. If you owe money for, let's say, 2006 and you realize that perhaps you were self-employed and you had some expenses on your self-employment that you forgot to claim, you can go back and amend that tax return and reduce what you owe, but you're not going to get a refund. You can only get a refund for the past 3 years. And that is all the questions that we have.
Thanks. Yes, and just as a reminder, I put it in the chat, but this webinar is being recorded and it will be available on the University of Minnesota Extension Personal Finance webpage in probably 7 to 10 days, and then also be able to be accessed at helpmmsave.org guys as well. And I will send all of that information out via email as well as it becomes available. So, like Helen said, we will stay on for a little bit in case there's any other questions. But otherwise, thank you so much for joining us, and have a great day.